Everyone thinks the dot-com crash happened because technology was too early. The real reason? People got rich on numbers that never existed. And then reality showed up with a receipt. Imagine waking up in a world where typing "com" after a company name magically made it worth billions. No profits, no customers, sometimes no product. Stocks were exploding upward. Founders were becoming billionaires on paper. And investors were throwing money like it was a party trick. Even economists were panicking, which is rare because they're usually confused, not scared. The official story goes like this. The internet was revolutionary, investors got overexcited, the bubble popped. Everyone learned a lesson. Sounds reasonable, comfortable. But that story hides the most important part. This wasn't just excitement. It was mass financial delusion. And here's the part they never emphasize. During the late 1990s, profits stopped mattering. Revenue optional. Cash flow irrelevant. A business model adorable but not required. All that mattered was this. Website traffic. Growth projections pulled straight out of thin air. Venture capitalists funded anything with a pitch deck and enough confidence. Investment banks pumped trash companies because IPO fees were addictive. This wasn't investing. It was greaterful gambling in suits. Like watching someone build a skyscraper out of PowerPoint slides. And calling it architecture. And the craziest part, everyone knew it made no sense. The warning signs were everywhere, like companies burning millions every month. Executives quietly dumping their own shares. Valuations rising faster than logic could keep up. But greed has a trick. It turns alarms into background noise. Then in 2000, confidence finally cracked. A few earnings misses, a few downgrades, and a few investors all trying to exit at the same time. That's all it took. Stocks collapsed. Liquidity disappeared. Optimism turned into panic overnight. Some people still say it wasn't a crash. It was a wealth transfer dressed up as innovation. This is the moment the system snapped. Nasdaq fell nearly 80%. Trillions in market value evaporated. Startups shut down by the thousands. Billionaires became millionaires. Millionaires became jobless. If money could scream, this is where it would have gone quiet. But here's the detail everyone ignores. The dot-com bubble didn't just destroy companies. It rewired how finance works to this day. It's why the investors obsess over profitability. And tech valuations are questioned the moment growth slows. So if you're building, investing, or job hunting in tech today, understand this. The rules you're playing by were written in the ashes of that collapse. The bubble popped, but the consequences stayed. And if you learn the rules, you can survive them. Here's the real lesson. Finance isn't about technology. It's about human behavior under the illusion of certainty. Every bubble looks rational while it's inflating. Every crash looks obvious afterward. And if you think this can't happen again, you already missed the point. Because you never know what the next bubble will look like until you're already inside it. The next bubble won't announce itself. It'll look like the future.